Hi, welcome to Family Wealth Planning Partners. I'm Brian Ramsey, and this is our weekly blog series. Today we're kicking off the first of a 5-part series on the different account types. Now we're going to evaluate these on a number of different ways. Today we're talking about pre-tax investing versus post-tax investing. Week 2 we're going to be talking about the different accounts that make up a pre-tax investing. Week 3 we're going to be looking at post-tax investing and the different accounts associated with that. Week 4, we're going to be talking about where to allocate $1, so what's the most effective account type at allocating your dollars, down to the least attractive account. And then week 5, we're going to be talking about the taxation of each of the accounts. So that makes up our 5-part series, but today we're talking about pre-tax versus post-tax. So we talk to clients all the time about having 2 different buckets of money or savings when it comes to how to allocate dollars. So you get a pre-tax bucket and a post-tax bucket. Let's look at the value. Let's evaluate each of the accounts. So on a pre-tax side, let's use $1,000 as an example. On a pre-tax side, we take $1,000 that comes out of your check before you get taxed, and it's invested in an account type. Now most people are aware of like a 401k, 403b. That's a very common pre-tax account. As that money is invested, it grows what we call on a tax deferred basis, meaning dividends and interest that you accumulate in the account. You don't pay tax on it, it's deferred till later. And then when you withdraw the funds in retirement, it's taxable. Now, not in every case, and there's an exception to the rule, and we'll talk about that next week when we get into the pre-tax accounts. But for the most part, we find when we work with clients that some form of their distribution is taxable in retirement. So let's take $1,000 for example. You take $1,000, you invest it in a 401k or a 403b. It comes out pre-tax, so you've not paid tax on that money yet. It grows tax deferred, which means dividends and interest again are not, you don't pay tax on that. And then when you withdraw, if you want, when you get into retirement, when you get into retirement, you want that same $1,000, you may have to take out $1,100 or $1,200 to get that same $1,000 because it's going to be taxable. Again, not in every case, but in most cases that's what we see. Now let's look at post-tax savings. So post-tax savings is money that you've already paid tax on. It's money maybe sitting in your checking account, and you want to allocate those dollars to an investment account. When you allocate those dollars to an investment account, those investments grow sometimes on a tax deferred basis, sometimes not. If it's not on a tax deferred basis, along the way when the money's invested, you may get dividends and interest and capital gains that you pay tax along the way. And then when you get to the distribution phase, some of the accounts are either tax-free withdrawals or they may be taxable, and we'll get to that in just a second. We do get more into detail of that in week 3 and we talk about post-tax savings accounts. But let's go back to the same $1,000 scenario. You invest the money in on a post-tax basis. It means you've already paid tax on it. It grows, and we'll say it's a non-retirement account, just a general brokerage account. So as you invest the money, you're going to pay dividends and interest along the way. And then when you go to take the withdrawal in retirement, you may have to pay taxes. If it's invested and you sell it at a capital gain, you may have that. Or if the money is already accumulating cash, you can withdraw that same $1,000 out of the account tax-free. And the reason we talk so much about the pre-tax and post-tax accounts with clients is there's a big difference between investing today in a pre-tax and a post-tax account and looking at the impact to that same investment 20, 30 years down the road. It's a big difference. And so when we get into the distribution phase of life, we want to make sure we have assets in both buckets so that we're not having to take all of our distributions out of a pre-tax bucket and having it taxed. And so it's just a good investment strategy to make sure that yes, you're saving on a pre-tax basis, but you're also saving on a post-tax basis. So that's it for this week. Tune in next week. We're going to be talking more detail around pre-tax and the accounts that are associated with pre-tax savings. That's it for this week. We'll catch you next week when we're talking pre-tax savings.